All right, we know that the bourse lost about 2 points. It's sideways trading, but apparently for the year, investors have lost about 330 billion Kenyan shillings on this market.
Yes, true. The market has basically been in a secular bearish trend, which will continue for some time. If you actually look at how markets operate, they're normally proponents of a four-stage market, how it works, where stage one is when you're coming out of a dip, stage two is your glory stage two, where everything is going up. Stage 3 is basically consolidation, and the Nairobi Stock Exchange currently is entering what we call stage 4, where we will see the market remain bearish for some time for that whole cycle to complete. Then we'll start going up again later, 6 months, a year, 2 years, who knows.
Have there been any companies that have outperformed the market irrespective of the downward trend? I know that foreigners still love the blue chip banks, for instance, Safaricom, but is there any company that's really worked against the grain?
The companies that have worked against the grain is your agricultural sector stocks, your tea stocks. This year tea has been good. Production yields have been very high. Prices have been record high also on that side. And you'll find counters like Williamson Tea, Kakuzi, Ria Vipingo, Limuru Tea. All those counters are actually up 40%, some of them 60%, in a market that is basically down 30%. So basically the people that stuck with them during their hard time, the beginning of the year and end of last year, have really benefited a lot.
What are the strategies that companies are going to employ to preserve cash, to grow in a market like this? I mean, Co-op Bank, for instance, has decided not to pay out dividends. So that's one strategy. What are other strategies available?
It's a bit of a tricky affair, especially banks can really do that. Even the dividends they pay is really marginal to the amount of cash that they actually hold because of statutory requirements. And most of them are actually very liquid in terms of cash reserves and the ratio side. So the banking sector is okay. When you go to your manufacturing sector, they now have to balance meeting demand and preserving your market share, and at the same time not passing out all the costs that have come with the weak shilling during the year. Even as much as the shilling is at 89, it's still down close to 10-11% year to date. So with the high input costs, the balance is do you cut expansion so that you absorb some of the costs so that you don't lose your market to substitutes or alternatives. So it's a really tricky affair in terms of how to strike the balance and maintain your business. If you see throughout the year, even the banking sector themselves really cut down on staff. They really try to remove that fixed aspect of labor and reduce it drastically. And most companies might see them doing that as we go along. We're having strike after strike, doctors, nurses, teachers, everyone wants higher salary. And that impact on the companies will be so hard that they will have to cut staff to cut costs.
The gainers in today's market, for instance, C&G up 7.4%, Everready up 6%. City Trust has been doing well anyway, continuing its trend upwards. What's the story for the others?
If you look at the volumes, again, it becomes hard to say actually that there is something in the counter. I'll give an example of Everready, which I think traded 600 shares the whole day, and it's gone up by close to 8% or 6%. So you find, again, when you're looking at little volume or moving a counter, then we really can't put any fundamental or any technical aspect to the rise.
Okay, let's move to the fixed income side of the market. The shilling is holding up. It's fairly steady. There's a bit of dollar demand because obviously it's effectively the start of the new month. So that's to be expected. But banks are offloading their involvement with treasury bills. They're not getting good yields, even though interest rates are rising. The cost of borrowing are rising. That just isn't a case for investing in this side of the market.
Yeah, especially for the banking sector, which is the largest investor in the government securities anyway. If I can lend to my fellow bank at 30%, 28%, why will I be caught in a 90-day treasury bill? And we also need to remember that banks are traders. They're doing business. They're not there to offer the government any favors or try to pamper the government. They'll go where they get the highest yield. And you'll find as we go along, that will be the trend. They'll rather have cash. They'll rather be in cash, where they will have flexibility of either lending overnight on the interbank rate, or if they see an opportunity in the treasury bill rates, if they think that it has reached a plateau, then they can move in. But as we go on, the government's job of trying to control the shilling might end up being counter effective, especially when it comes to their borrowing, coming into a year where they are planning on spending on elections. So the problem that we really have is we have a monetary policy that is being tightened, and we have a loose fiscal policy, and you can't just match the two.
You mentioned that banks in general have sufficient cash reserves, but we are seeing the cash reserve rate set to go up in the next week. What impact is that going to have on the market?
Basically, they're going to mop up the shilling. Again, that the main goal clearly seems as shoring up the Kenya shilling, making it stronger. That's the impact that you'll see in terms of the currency side. But on the other side, we again now start seeing more under subscriptions when it comes to treasury bills. Because if you squeeze the little money that I have, I will definitely even look for the highest return before I give it to you at 18%.